SPCX just broke the exact level the options market had marked as its floor. It opened at $158.992, fell to $148.86, and closed at $149.47. And that close puts it right on top of the biggest wall on the whole board. What's up, guys? Coach B here. This is episode 1 of a brand new series I'm calling The Breakdown. Every episode, we take one hot name and go straight into what the options chain is actually saying about it. No price targets, no predictions, just what the market is pricing right now. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell anything here. Do your own research. All right, let's look at the whole move first. SPCX opened at $150 back on June 12th and ran hard, all the way to an intraday high of $225.64 within days. From there, it came back down to earth and spent the next few weeks chopping mostly between $150 and $190. 3 separate times in the back half of June, on the 23rd, the 25th, and the 26th, the stock came back down and tested that same shelf, bottoming near $147, $150, and $148 each time before bouncing. That $150 level held every single time it got tested. Then came July 7th. The stock opened at $158.92, a level it had been trading well above for days. It sold off hard all session, hit a low of $148.86, sliced clean through that same $150 floor, and closed at $149.47 on 83.4 million shares. The floor that held 3 times just gave out. So let's pull up the actual option chain. The expiration I'm using for this breakdown is August 7th, 30 days out, and at the money is the 149 strike. Implied volatility there is running right around 86%. That's expensive. It's the options market telling you it expects this thing to keep moving in either direction. Here's what that IV actually costs you. The at the money straddle, the 149 call plus the 149 put, prices out to right around $29 combined against a $149.47 stock. That's the options market pricing in about a 19% move up or down before that August 7th expiration. That's not a prediction of direction. It's just the size of the move being priced in, and that IV cuts both ways. Say you bought that 149 call outright for around $16 near the ask. That option is losing about 24 cents a day to time decay alone before the stock even has to move against you. On a hot name with IV this high, the premium you pay is the first thing working against you. Now here's the real story on this board, the open interest. Add up every expiration listed on this chain, and the 150 put strike is holding about 180,000 contracts. That's the single biggest wall anywhere on the entire board, calls or puts. Below it, the 135 strike holds around 111,000, and 140 holds about 87,000. On the call side, the wall sits higher, up at 160, 165, and 170, each holding somewhere between 48 and 54,000 contracts. Run all of that through the max pain math, and it lands around $160 above where the stock actually closed. Max pain is a tendency, not a law. It's just the strike where the options market's aggregate pain would be lowest if everything expired today. But look at the actual structure, spot at 149.47, the single biggest wall on the board sitting right underneath it at 150, and a call wall building well above at 160 to 170. That's what the options market is actually built here. Now let's talk about gamma for a second, because this is the part that explains why a name like this can whip around so fast. Gamma is how fast an options delta changes as the stock moves, and the closer you get to expiration, the more that number explodes for strikes sitting near the money. Right now we're 30 days out on this contract. Picture that same curve compressed down to 7 days out, then down to 1 day out. Same stock, same strike, but the sensitivity gets dramatically sharper the closer expiration gets. That's not unique to SPCX. It's just how every option chain behaves as the clock runs down. Now layer the actual open interest onto that gamma curve, and here's where it concentrates on SPCX right now. Pull the gamma reading across every strike in this chain, and it clusters heaviest in the 146 to 152 range, right on both sides of where spot is sitting at 149.47. That's not an accident. That's the zone with the most live contracts changing hands close to the money. The 150 put strike carries the single biggest pile of contracts on the board, And just below it, the 146 to 148 strikes are actually carrying the highest gamma readings in the entire chain. Layer in the call wall building at 160, 165, and 170, and you've got heavy hedging math sitting on both sides of where this stock just closed. Again, that's a description of where the positioning and the hedging pressure concentrate, not a call on which way this breaks. So how would you think about that by time frame? If you're trading this day to day, 86% IV and 83 million shares of volume means you're trading pure volatility. This thing can move fast either way. If you're swinging it, the level to actually watch is whether $150 gets reclaimed as support or flips into resistance from below, because that's exactly where the options market has parked its biggest position. And if you bought this back at the IPO and you're playing the long game, one session doesn't change the picture. You're watching whether the bigger range holds over weeks, not one red candle. So that's episode 1 of the breakdown. SPCX broke a floor that had held 3 times. It's now sitting right on the biggest put wall on the board at 150, with gamma clustering heaviest just below that in the 146 to 148 zone, a call wall building overhead at 160 to 170, and max pain reading around 160. Same reminder as always, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. Subscribe and drop the next ticker you want me to break down in the comments. I'll do the exact same thing to it next episode. Good luck in the markets, no matter what stock you're into.